All right, welcome everyone. Think of this session as a masterclass on what I believe is the single most important lesson for any aspiring trader. We are going to dive deep into the mathematical foundations of what makes a real trading edge, and we're pulling everything directly from Chapter 4 of the Trading Academic.
So, let me ask you a question right off the bat. What if I told you that you could be a consistently profitable trader, even if you lose on 60% of your trades? I know, it sounds totally backwards, maybe even impossible, right? But stick with me, because by the end of this, you're going to understand the exact math that makes this a reality.
Okay, let's get right into it. The first building block, the absolute cornerstone of all professional trading, is understanding a concept called mathematical expectancy. This is really where we separate professional analysis from just, gambling.
So what is it exactly? Well, put simply, it's the average profit or loss you can expect to make on every single trade you take. But, and this is the most important part, it's over a large sample size. See, this isn't about trying to predict the next trade. It's about knowing, with statistical confidence, what your average trade is worth over hundreds, maybe thousands of times.
In this formula right here, this is the engine that drives the whole thing. It looks simple, but it is everything. It tells you in plain black and white whether you have a positive edge that's even worth trading. Your expectancy, or E, is just your win rate times your average win minus your loss rate times your average loss. It's just a beautifully simple way to put a number on your advantage.
Now, theory is one thing, but let's make this real. Have a look at this hypothetical strategy. The first thing you should notice is the win rate is only 55%. That's barely better than a coin flip. Our average win is £150, and our average loss is a little smaller at 120. So let's plug these numbers into that formula we just saw. And boom, there's the magic. After you run the calculation, this strategy has a positive expectancy. On average, every single time you put on a trade is worth a positive £28.50. It doesn't matter if your next 3 trades are losers. Over the long run, the math is on your side. This number, this is your edge.
So, let's build on that, because this leads us to a really crucial idea, a trade-off really. It's not just about how often you win. It's about the relationship between how much you win when you're right versus how much you lose when you're wrong.
And this brings us to a really powerful question, one that can completely change your psychology around trading. What's the absolute minimum win rate you need to just break even? Seriously, answering this can free you from that emotional trap of feeling like you have to be right all the time.
And what's so cool is that there's an elegant little formula for this. Your break-even win rate is just 1 divided by 1 plus your reward-to-risk ratio. The implication here is huge. The bigger your average winning trades are compared to your losing trades, the less often you actually need to be right to make money.
And this slide just illustrates that trade-off perfectly. On the left, you've got a high win rate strategy. It wins 70% of the time. That feels amazing, right? But look closer. Its break-even rate is 67%. You have almost no room for error. If your performance slips just a little bit, you're losing money. Now look at the right, a high-reward strategy. It only wins 40% of the time. Think about that. You're wrong more often than you're right. But because your wins are 3 times your losses, you only need to be right 25% of the time just to break even. It's psychologically tough for sure, but you've got this massive mathematical buffer.
Okay, so you've done the math and you've confirmed you have a positive expectancy. Great. The next logical question, and honestly, this might be the most important one for survival, is how much of your capital should you actually risk on any single trade?
Well, the purely mathematical answer to that question is something called the Kelly criterion. It's a famous formula that tells you the optimal fraction of your capital to risk on a bet to maximize your long-term growth. It's designed to make your account grow as fast as mathematically possible. But, and this is a huge but, you have to pay attention to this, the textbook is very clear. The Kelly criterion is used in fractional form to manage estimation risk. What does that mean? It means the pure formula is way too aggressive for the real world because we never know our true win rates and reward ratios with perfect certainty. There's always some guesswork. And why is this so critical? This chart shows it all. If you use the full Kelly bet size, yeah, you get the fastest growth, but you also get a terrifyingly high risk of ruin, of blowing up your account. But look what happens when you just cut that bet size to half, or even a quarter Kelly. You dramatically slash your risk of blowing up, but you still capture most of the long-term growth. That right there is professional risk management. Now it's time for a little dose of hard reality. Let's say you've had a great month.
Your expectancy math looks good on paper, but is your edge actually statistically real, or did you just get lucky?
This is such a classic trap for new traders. You have 15 wins out of 20 trades, and you're on top of the world, convinced you've found the Holy Grail. But is a tiny sample size of 20 trades anywhere near enough to prove anything?
The hard truth is, a small sample size proves almost nothing. With 15 wins out of 20, the 95% confidence interval for your true win rate is enormous. It could be as low as 52% or as high as 92%. You just don't know. You need hundreds, if not thousands of trades to have any real statistical confidence. So this is why the pros don't just rely on their initial results. They stress test their strategies. And one of the most powerful ways to do that is with something called a Monte Carlo simulation. It basically tests your system against thousands of different random futures to see if your edge can survive a really bad run of luck. So how does it work? It's actually pretty clever. You take your real historical trade results, say 200 of them. Then in a computer, you randomly shuffle the sequence of those trades thousands of times. This answers a vital question. Was your profit because of a real edge, or did you just happen to get all your big winning trades at the beginning? This is how you rigorously separate skill from just pure dumb luck.
So at this point, you're probably wondering, if markets are supposed to be so efficient and random, where do these mathematical edges even come from in the first place?
Well, the answer lies in this key insight from the textbook. Price series are neither perfectly random nor perfectly predictable. They occupy an intermediate regime. Basically, the market isn't a perfect coin flip, but it's not perfectly orderly either. It's in this messy middle ground, this gray area, that real edges can be found.
And here are some of the specific documented statistical quirks of markets that create these opportunities. You've got fat tails, which just means that wild, extreme market moves happen way more often than standard statistics would predict. There's volatility clustering, the simple observation that big moves tend to be followed by other big moves. And finally, momentum, the tendency for trends to keep going once they start. These are the non-random patterns that a professional trader learns to exploit.
And so ultimately, this is the challenge that Chapter 4 leaves us with. Success in trading isn't about some magic indicator or a gut feeling. The market is, at its very core, a math problem. And the final question is, have you done your homework?
For those of you who are serious about doing that homework and want to continue your studies, this slide lists the essential texts that are recommended at the end of the chapter. They'll let you take a much deeper dive into position sizing, strategy testing, and the very nature of the markets themselves. This is the path to real competence.